Have you ever wondered how cities are transforming their downtown cores to adapt to post-pandemic realities? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In Chicago, the transformation of office spaces into residential units is gaining momentum, with the city's Community Development Commission recently approving a substantial subsidy for such a project. The Commission has given the green light for nearly $68 million in tax increment financing to assist in converting a 41-story tower at 105 West Adams Street into 400 apartments. This project is part of a broader initiative launched in 2022 by former Mayor Lori Lightfoot and continued by Mayor Brandon Johnson, aimed at revitalizing the Loop's office spaces into residential units. The proposal, driven by Primera Group, a Chicago-based developer, is the sixth project under this initiative. The goal is to breathe life back into the city's core by transforming outdated office buildings into vibrant living spaces, thereby increasing foot traffic and economic activity in the downtown area. This move aligns with the city's efforts to counteract the impact of new work patterns that emerged during the COVID-19 pandemic, which resulted in record-high office vacancy rates. The financial package for this project is notable, with tax increment financing covering nearly 37% of the project's costs, which is higher than the typical 20% subsidy seen in most real estate projects. This funding is contingent upon at least 30% of the new apartments being affordable to households earning an average of 60% of the area's median income. This means that approximately 121 of the 400 units will be designated as affordable housing. Primera Group's project at 105 West Adams Street is set to kick off in January, with completion targeted for June 2027. The development will include a mix of studio, one-bedroom, and two-bedroom units, along with amenities such as a rooftop terrace and nearly 29,000 square feet of commercial space on the building's lower floors, intended for neighborhood amenities like a grocer and restaurants. This initiative is part of Chicago's broader strategy to use public resources to invigorate its downtown area, a move that has sparked debate. While supporters see it as a way to accelerate the Loop's recovery, critics question the allocation of public funds for such projects, suggesting that there are bigger challenges to making the Loop a more attractive residential area. The market for distressed office buildings is currently experiencing both challenges and opportunities. A notable example is the Pruneyard office campus in Campbell, California, which was sold this year at a discount exceeding 60%, with PSAI Realty Partners acquiring it for $54 million. Distressed office assets are in demand despite their inherent risks, as they present substantial opportunities for investors willing to take on the challenge. Lucas Kraus, Chief Executive Officer of SVN International Corporation, highlighted that private capital investors are seizing the chance to acquire office properties at historic discounts. These investors are particularly interested in distressed and value-add opportunities in resilient urban cores and fast-growing metropolitan areas. This trend reflects a belief in the long-term recovery and relevance of office space, albeit repositioned to meet the evolving needs of the future workforce. The most sought-after distressed office acquisitions are located in major central business districts within primary markets known for their robust fundamentals and historical resilience. Sunbelt metropolitan areas are also attracting interest due to their ongoing population and employment growth. Investors are leveraging significant discounts as cushions to implement repositioning or value enhancement strategies. The sellers of these distressed office buildings are often institutional investors, such as pension funds and investment managers, who are divesting underperforming or non-core assets to rebalance their portfolios. According to Benjamin Adams, Chief Executive Officer of Tenant Capital Management, the aftermath of the pandemic has led to a fractionalization within the asset class, resulting in varied buyers and sellers across different micro-markets. Family offices are increasingly participating in middle-market transactions, particularly in note sales. They benefit from the ability to take a longer-term perspective, unlike conventional closed-end funds, with restricted investment periods. Family offices also tend to act quickly and are more comfortable with the risks associated with limited contingencies or due diligence in note sale environments. Private capital entities, including private equity firms, family offices, and high net worth individuals, are actively investing in discounted office assets. They aim for turnaround and value creation, focusing on primary markets that are accustomed to resilience and recovery after downturns. These investors are motivated by the potential to reposition assets through leasing strategies and property improvements, while also anticipating future market recovery. In Miami, two main types of buyers are dominating the distressed office market: owner-users taking advantage of opportunistic pricing and developers seeking to convert these buildings into multifamily or mixed-use properties. Holly McDonald Korth, Chief Executive Officer of KDM Financial, noted that with rising housing demand, underutilized office spaces, especially in urban cores and outer suburbs, are becoming attractive to developers. On the West Coast, many distressed office building buyers are owner-operators aiming for long-term control over their real estate at discounted prices. Recent significant transactions include Microsoft's acquisition of a 643,000 square foot campus in Mountain View for $330 million in an all-cash transaction, and NVIDIA's expenditure of $374 million for a 7-building property. Despite the attractive discounts, distressed deals come with serious risks. Stephen Sonny Ginsberg, partner at the commercial real estate law firm Ginsberg Jacobs LLC, emphasized the importance of buyer due diligence, as these properties are often sold at the direction of a lender with limited representations. Buyers must perform timely due diligence at their own cost, as the selling entity may receive little or no equity from the sale. The Rio Grande Valley, located at the southernmost tip of Texas, is rapidly emerging as a fast-growing retail hub, according to Jason Baker of Baker Katz. This region, comprising Starr County, Hidalgo County, Willacy County, and Cameron County, is positioned along the northern bank of the Rio Grande River, which serves as the border between Mexico and the United States. Despite common misconceptions about border regions, the Rio Grande Valley has evolved into a significant international trade destination within Texas, which is recognized as the 8th largest economy globally. The area has undergone considerable transformation, driven by population growth, a burgeoning healthcare industry, and robust commerce with Mexico. This transformation has resulted in first-rate commercial, retail, industrial, medical, retirement, and educational facilities. As Rice University's Kinder Institute for Urban Research describes it, the region is becoming a rising borderland metropolis. With a sizable binational population of approximately 2.67 million residents, 1.29 million in the U.S., and 1.38 million in Mexico, it is the second largest U.S.-Mexico border municipality after San Diego Tijuana. One of the key factors propelling the retail boom in the Rio Grande Valley is its unique demographics. The region boasts one of the fastest-growing populations in the United States, fueled by both domestic migration and cross-border commerce. The area features 12 international ports of entry that handle over $41 billion in cross-border cargo. Retailers in the Rio Grande Valley benefit significantly from the daily influx of shoppers from Mexico, many of whom are not captured in U.S. Census data, potentially being overlooked in market analyses. This steady stream of cross-border consumer traffic is substantial, with Nielsen estimating over 3.5 million yearly crossings. Importantly, this traffic is consistent throughout the year, providing a continuous boost to retail sales in the region. Nearly 63% of these consumers make the trip at least once a month, with frequent visitors crossing the border 5 or more times monthly. Additionally, the Rio Grande Valley attracts retirees seeking affordable alternatives to places like Florida, along with so-called winter Texans who spend the winter months in the region. These seasonal residents often bring higher disposable incomes, creating additional revenue streams for retailers. Despite these demographic advantages, the valley remains under-recognized by many national retailers, who may hold outdated perceptions of the area as unstable or lacking a strong consumer base. Cities within the valley, such as McAllen and Brownsville, report high retail sales, with some locations ranking among the best-performing stores nationally in sectors like big box discount, soft goods, and electronics. The diversity of residents and visitors supports a wide range of retail offerings, from discount retailers to luxury brands. For instance, La Plaza Mall in McAllen has attracted notable retailers, including H&M, Zara, Mango, Lululemon, Kendra Scott, and Guess. In 2024, McAllen Mayor Javier Villalobos highlighted the city's retail dominance, noting that local retailers earned $96.8 million in sales tax revenues, setting a record for the city. Grocery, dining, and entertainment sectors have also thrived, with niche grocery stores and several restaurants reporting some of their highest sales and margins nationally. Baker Katz, representing Darden Restaurants, has expanded significantly in the region, experiencing growth with dining concepts like Yard House, Olive Garden, Longhorn Steakhouse, and Cheddar's. For retailers considering entering the Rio Grande Valley market, understanding the local competition and logistics of cross-border shopping is crucial. Success often depends on tailoring offerings to the local consumer base, incorporating bilingual marketing, culturally relevant branding, and community engagement. The Rio Grande Valley, with its diverse and loyal customer base, strong cross-border commerce, and record-breaking retail sales, presents an opportunity for those willing to look beyond outdated perceptions and recognize the region's potential. Audrey Henvey from DCEO Real Estate reports that Legacy West, one of the region's most successful mixed-use developments, has been sold for a record $785 million. Kite Realty Group and GIC acquired the 1.15 million square foot property, located at the northwest corner of the Dallas North Tollway and State Highway 121. This property, which opened in 2017, has been managed by operating partner Prism Places since 2019. The development was originally created by Carahan Companies and Columbus Realty. Prism, Open Realty, and Invesco Real Estate have been guiding the mixed-use strategy, leading to a retail and office occupancy rate of more than 95% and a 63% increase in net operating income since 2019. John A. Kite, Chief Executive Officer of Kite Realty, stated that Legacy West is an iconic mixed-use asset with significant mark-to-market potential, further establishing their prominent presence in the Dallas metropolitan statistical area. Kite Realty plans to fund its investment strategically, utilizing a blend of asset sales and debt to ensure the transaction is accretive to earnings, enhances the portfolio quality, and maintains leverage at or below their long-term target of 5 to 5.5 times net debt to earnings before interest, taxes, depreciation, and amortization. In other news, Hoke Global has broken ground on a mixed-use development in southern Dallas known as University Hills. This development will include urban homes, commercial buildings, a town center, and green spaces. Home builders DR, Horton and Lennar have purchased 580 lots on site. Hoke Global has partnered with KDC to develop build-to-suit office space, and Pegasus Ablon is adding premier retail to the development, including a grocery store. The site will also feature the first United States location of Hotel Local, which debuted in Dubai last month in partnership with Dave Johnson under the Marriott International System. In McKinney, KDC has started construction on a $10 million headquarters and training facility for Hugs Cafe. This two-story, 13,500 square foot facility will include a cafe, training academy and kitchen, 4 classrooms, a rooftop deck and patio, offices, and workspaces. Hugs Cafe is a social enterprise-focused organization addressing high unemployment rates among adults with disabilities who wish to work. The headquarters project is supported by KDC, HEB, Salmons Enterprises, the McKinney Community Development Corporation, Compatriot Capital, and others. First Industrial Realty Trust has initiated the construction of the 6th and final building of the First Park 121 Industrial Park in Louisville. This speculative build is expected to be completed in summer 2026, with an estimated total investment of $23 million. Building F will include a 36-foot clear height, 36 dock-high door positions, 2 ramps, 49 trailer stalls, 118 auto spaces, and early suppression fast response sprinklers. Adam Graham and Mark Graybill of Lee & Associates will handle leasing for the project in partnership with First Industrial. Saris Builders is the general contractor, Alliance Architects is the architect, and Westwood is the civil engineer. In the multifamily sector, Larkspur Capital is constructing 155 build-for-rent townhomes across 8 acres in the Cedars, a qualified opportunity zone south of downtown Dallas. The rental community, named Victoria Row, will feature 1, 2, and 3-bedroom options, along with amenities like a pool, cabana, shade pavilion, dog park, and fenced lawns and courtyards. Architecture Demarest, B2 Design Coens, and Garrison/Jones. Landscape architects are development partners on the project. Acadian Group is the general contractor, and the project is slated for completion in early 2026. In office leasing news, the law firm McDermott, Will & Emery has relocated to a 25,024 square foot space on the top floor of Harwood No. 14. The new office will house 65 lawyers and professional staff. Phil Puckett, Harlan Davis, Clay Hammerstein, and Patrick Moody of CBRE brokered the deal on behalf of the tenant. Legend Conversion has signed a 16,000 square foot lease for office and warehouse space in Alvarado, about 30 miles south of Fort Worth. This relocation from the Mid-Cities was facilitated by Luke Clardy of Bradford's Fort Worth team with the landlord AAN Development, represented by Todd Lambeth and Cade Navarro of Bradford Commercial Real Estate Services, Fort Worth team. In retail leasing, Majestic Nail Bar has leased a 5,400 square foot freestanding retail building at Arbrook Oaks Shopping Center in Arlington, Texas. The landlord, SWC Arbrook/157, was represented by Kevin Butkus and Guillermo Lopez with Weitzman. Arbrook Oaks is now fully occupied. In Eagle, Idaho, a new commercial office park is set to change the landscape at the intersection of State Street and Highway 44. Margaret Carmel from Boise Dev reports that the Eagle City Council has approved the design for a 14-building development known as Riverwood Condominiums. This project, developed by local resident Mark Bigelow and represented by Julie Rivers Development, will feature a mix of business, professional, retail, and restaurant spaces. The site, which spans 8 acres, is already zoned for mixed use and will consist of 7 buildings at 5,600 square feet, 4 buildings at 5,500 square feet, and 3 buildings at 3,250 square feet. These structures are designed to be flex buildings, with 50% dedicated to office space, 35% to light retail, and 15% to restaurant space. A notable aspect of this development is the option for tenants to purchase or rent space, providing opportunities for end users such as accountants or chiropractors to own their office. The design will also incorporate a 10-foot wide multi-use path and streetscapes with trees and landscaping to enhance pedestrian circulation and comfort. The buildings will feature 2 architectural styles, Craftsman and English Cottage Farmhouse. The council's approval came after discussions around waste management, where concerns about trash capacity and potential rodent issues were raised. Justin Waters of Julie Rivers Development assured the council that their waste management plan would prevent any such issues, ensuring cleanliness and aesthetic appeal for the development. Riverwood Condominiums is poised to bring a new dimension to Eagle's commercial landscape, offering a blend of office, retail, and dining options in a thoughtfully designed environment. This development reflects a growing trend in areas like Eagle to create mixed-use spaces that cater to diverse business needs while enhancing community aesthetics. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.